Hi, I'm Michael Yardney, and if I've read one story about the possible housing bust in Australia, I've read 100. Barely a week goes by without another breathless warning of some property pessimist, a columnist, or an overseas economist about our looming property price collapse. It's complete nonsense in my opinion. For starters, there's no national housing market. Prices vary widely from state to state, from place to place, and they always will. So while Melbourne and Sydney may look pretty pricey, most other cities simply don't. It seems that ever since the property market bottomed just over 2 years ago, in the middle of 2012, some, mainly foreign commentators, have suggested we're in a property bubble and it's about to burst. They told us we're in denial about the impending gloom. We're blinded by our own exuberance about the consistent performance of the property markets over the years. In many cases, these were the same property pessimists who told us we were going to be in for a crash after the GFC. Now they're saying it's related to the China-driven mining boom fading. Of course, there's also the local property pessimists who've been waiting for over a decade for our property prices to crash. So are we in a housing boom, or is there a bubble about to burst? Bottom line is, there's not a bubble when it's not about to burst. Sure, property prices are expensive in some locations, but that doesn't make a bubble. So let's talk a little bit about what makes a bubble and what's really going on. You see, a housing bubble doesn't just mean house prices are high. Prices can be high in response to supply and demand. They're simple basics. A housing bubble is defined by a rapid rise in property prices, where house prices are a long way from what is fundamentally considered justified. And this generally occurs when speculators enter a market where demand's already high and they attempt to profit through short-term buying and selling, further driving up demand. It's also usually associated with strong credit growth. Now, the latest house price results for, let's go back to October, suggest a rather tame residential market. We had a lull mid-year and then prices start rising again, and overall they're up about 9.3% over the last year because of favourable influences: low interest rates and undersupply in some areas, strong population growth and rising consumer confidence. However, individual performances remain patchy and mixed, both between different capital cities and within different market segments within each capital city. I guess they're reflecting the underlying impact of local supply and demand, as well as economic factors. Now, if you look at the Sydney market, it's booming. But if you look back over the past decade or so, Sydney house prices have only just outperformed inflation. In fact, they've risen at about 3.8% per annum over the last decade. Now, that's hardly bubble material. In general, in Australia, home prices dropped in 2011, they bottomed in 2012, and they started retracing as investors and home buyers embraced an attractive market and economic conditions. I guess what we're experiencing is the normal machinations of the property cycle. What happens is property values rise and then they slump for a while, then they retrace, and they finally go up into the next expansionary phase, as I guess is what's happening now. Now, the current price growth, around 9% per annum, is more or less in line with the long-term averages. While dwelling prices are up 19% from the mid-2012 trough, they're only about 10% above their previous peak, which was way back in 2010. And in particular, these gains are in the Sydney market, but that was the market that was flat for 2004 to 2008. And capital growth in regional areas and in other areas are more restrained. But remember, this is what the government wanted. The Reserve Bank lowered interest rates to stimulate our economy and balance out the results of the mining boom slowing down. Low interest rates improved housing affordability, which contributed to increased home buyer demand. This led to higher house prices, which encouraged builders to build more new homes. Dwelling approvals are about as high as they've ever been, leading to a construction boom. Remember, that's what the Reserve Bank wanted. Higher house prices, I can't even say it, create a wealth effect, increasing overall consumer confidence. And this has been positive for retail sales. So again, this is exactly what the RBA was looking for. It wanted the housing sector to rebalance our economy away from the mining sector. But some people were saying, aren't house prices way too expensive already? Well, yes, they are expensive by world standards, but that's a reflection of the fact that most of our population is concentrated in a few coastal capital cities. We've also got a high quality of large housing stock, generally on big blocks of land. Plus the poor state of our public transport in our big cities only increases the premium for properties close to the CBD. Of course, this has some bubblers saying that houses are now overvalued and unaffordable because the rise in house prices over the past couple of decades vastly outperformed the rise in wages. What they seem to be ignoring is the preferred measure of affordability in Australia, which is the proportion of income spent on housing costs. For home buyers, not renters, the best measure of affordability is repayment of new housing loans as a percentage of not income but disposable income. This measure is now around the 30-year average. It's about a little over 20% and it's falling due to low and stable interest rates. Currently, typical standard variable interest rates is at historic lows. Household savings are the highest level in 25 years. Household debt has been flat. And so we're in a pretty good financial position in our households. Now, some people say, what about credit growth? Strong credit growth is fueling this housing bubble. The bubblers warn that if more people are taking on debt and becoming heavily leveraged, a change in the wider economy, such as a rise in interest rates or unemployment, could see mortgage holders struggle to repay their debt. And while that's true, the fact is that low interest rates, the current low interest rate environment, is not causing a rise in amount of credit. Credit has hardly lifted off its historic lows. Part of the reason why credit growth is growing at a slower pace is that about half of the households, according to anecdotal evidence, have not been reducing their regular mortgage repayments as interest rates fell. In other words, they're paying off their mortgage debts faster than they could. Another factor is our banks' high lending standards compared to lax standards overseas. Those standards that eventually led to the US meltdown in 2008. So what could cause our property markets to collapse? You see, it's not as simplistic as what bubblers think. House prices collapse, not the cyclical correction, collapse, when people are just forced to sell their homes and there's no one willing to buy them. Now, sure, the market's going to turn again one day, but that doesn't mean property values are going to crash. What tends to happen is people choose to simply remain in their homes and wait things out, while property investors also try to hold on rather than realising their capital losses. So a true collapse, a crash, a property bubble bursting would require some external shock, such as maybe high interest or unemployment rates that could trigger a wave of forced home sales. Now, while unemployment's creeping up a bit, no one's suggesting we're going to have crippling unemployment rates in the foreseeable future. The second factor could be high interest rates that would cause a raft of homeowners to default on their mortgages. Now again, this is unlikely. Or the other factor that could cause houses to crash is a recession that would cripple the economy. Now that doesn't seem on the radar for any economists. And the last one, I guess, is a severe oversupply of property. Now this could occur in a few isolated markets, but generally we've got an oversupply, an undersupply of properties. So let's look at what's ahead. Look, I must admit I can't see property values continuing to grow at double-digit rates forever. That's unsustainable at a time when inflation is less than 3% and interest rates are as low as they are. However, despite many factors that affect the long-term property values, there are two big ones, and they are population growth and the wealth of the nation. Combining both of these factors is a powerful stimulus for property price growth. More people needing to live somewhere and being able to afford to pay to do so. Now, there's little doubt that our population is going to continue to increase as Australia imports people to help replace retiring baby boomers. In fact, our population is likely to grow by about 10% in the next 5 years. At the same time, we're geographically situated in that part of the world that's going to drive the world's economy in the next few decades. We're approximately to China, to India, to Indonesia, to Japan, those are the areas that are forecast to have a massive growth. That's going to flow onto our economy. That's where the majority of the growth is going to occur by about 2050. So putting this into context, China's GDP is likely to expand 10 times between now and 2050. The economic strength of our major trading partners is going to ensure Australia's long-term economy. At the same time, this flood of wealth in our region will bode well for our investments, because foreigners are going to keep divesting some of their money into Australia. They see it as a safe economic and political haven. Some will buy property here to give their children access to better education. Others will buy property to strengthen their future residency and visa applications. So, putting all that together, sure, Australia is amongst the most expensive property markets in the world. But just because something is expensive for some doesn't mean a bubble's ready to burst and that property prices are going to drop dramatically. Although prices can drop dramatically in the stock market, the property market's a very specialised market. Again, they could drop in mining towns, in holiday spots, subject to large swings, but the price of well-located residential properties where the average Australian lives, they're historically much, much more stable. We haven't had a property bubble crash since 1890. We haven't seen a capital city market in Australia where properties fell through the floor since then, and they're unlikely to do so in the future. You see, the property market's the only investment market controlled by non-investors. 70% of all the properties are owned by mums and dads as their homes. Now, they're not going to sell up if the economy tanks or if the stock market crashes. This gives residential real estate a level of stability not available to any other asset class. So all the unease about housing bubble is unfounded. But if property values do keep rising at the rate they have in Sydney and Melbourne, of course we could get ourselves into a bit of trouble and have a correction, but not a crash. However, the good news is that the rapid rise of property prices over the past year or two seems to be moderating over the last couple of months, and we're getting back to maybe the sort of growth we should be. I guess that also means that not all properties are going to keep increasing in value, and you can't count on that. So if you want to grow your wealth through property, you've got to select investment grade properties. If you want to get help with that, if you want to have a look at how your current portfolio is working, or have a talk with somebody who could help you get going if you're just wanting to start in property, why not have a chat with the unbiased professionals at Metropole Property Strategists? Give us a call at 1300 20 30 30 or go to metropole.com.au, and we'd love to give you 45 minutes of our time, obligation free, to see what your options are.